Concluding remarks from the President of the United States, wrapping up a busy week for President Biden on the international stage, from the G7 in Bavaria, Germany, to Madrid, Spain, for a meeting of NATO leaders. In the President's own words, the world has changed and NATO has changed as well, acknowledging problems abroad, influencing problems at home. Joining us now to discuss is iCapital's Anastasia Amoroso, Jonathan Golub at Credit Suisse. To the two of you, thank you for being so patient as we work our way through to the opening bell. As we listen to the President's remarks, futures are down by a little more than 1%. And Anastasia, I want to go straight to your mid-year outlook. It was a fantastic read, and go straight to your assessment on the consumer. It is no more reopening and travel chasing at all costs. You go on to say no more revenge spending, no more excessive home goods buying as they face the sobering reality of higher costs. Has that consumer recession, Anastasia, for you already started?
Well, John, we should clarify what we mean by a recession. And if you mean that it's several negative consecutive quarters of GDP growth, no, that is not my case. I don't think we have that negative outright growth. But I do think that the consumer slowdown is underway. And frankly, we've been talking about for months, this is going to be a consumer-led slowdown in the economy. So the good part about this, if you think about the last 2 years, it has been anything but normal. And we've built imbalances here and there. We've been built dislocations. So this is about coming back to normal. This is about coming back to prudence. And by the way, I don't think that's a bad thing for the economy, but it does mean that we're not going to grow 3 or 4% in terms of GDP. We're going to grow at 2% or probably even sub 2% as we progress to the end of the year. So that's just the reality. And as a market participant, you have to adjust to that and obviously position accordingly.
Jonathan Golub, people have been adjusting to that. How well priced is that story now?
Listen, we're very much. I'm very much on the same page with Anastasia. I think that we have to differentiate between a recession and a slowdown. GDP. If you look on, and you and I have talked about this. If you look at the Bloomberg survey on ECFC, which is a Bloomberg function, it tells you that last summer we were expecting, economists across the industry, about 4.5% economic growth. Right now, the expectation for this year's economic growth is 2.5%. And my guess is by the time the year's over, it's 2%. But that is not a contraction in overall activity. If you look at both the first quarter's GDP and what's expected for the second quarter, is again a weaker GDP number, but a positive consumer spending. Today's report is very much supporting that thesis, which is things are clearly slowing down. Inflation is the big culprit for that, but it's not recessionary, at least not for the moment, and probably not for the next 6 to 12 months.
So, John, what's going on with these retailers? I'll just go through some single names and maybe you can summarize the whole industry for me. Walmart down 11% on May 17th. Apparently that was a surprise. Target down 25% on May 18th. Apparently that was a surprise. Yesterday, Bed Bath & Beyond down 24%. Apparently that was a surprise. And, John, every time I see these retailers come out with guidance, with numbers, I'm surprised people are surprised, because we've been talking about these issues for ages. So I really want to lead into this point, John. Just how well priced is this story? And will this feel like a recession in certain industries?
Well, I mean, you have to break down what's happening at those retailers. The first thing, and this is a theme that we've been hearing about, this idea that we're going to rotate from buying goods to services. When we were locked down, we all got a new flat screen TV and leather couch because we were going to be spending more time at home, and we invested in a new leaf blower to do our backyard and gardens, and we don't need to go and buy those again. So what you're seeing is a rotation away from those purchases to some other things. What you heard from, in particular, Walmart and Target, was that they were mismerchandised. They had the things that we've already bought. And so I don't think you have a general consumption problem. And listen, it's getting weaker, as much as a shift away from some of the things that we've been spending money on in the past. And that's what you're seeing more than anything else. The second issue at these retailers, and this is something that's interesting, is that margins have held up surprisingly well across the entire S&P 500, but they have not held up well in consumer stocks. So it's not an indication of the health of the consumer, but these businesses, for some reason, are really they're struggling to deliver profits in this environment, which is beyond simply consumer demand.
It's been a massive struggle for that industry. It's been a big, big struggle at the index level too. As we close out the first half, we're down hard so far this year to date. Your base case, Anastasia, I'm just looking at the growth numbers you're expecting here for the US and the Eurozone, likely to slow to 1.5% year over year by the fourth quarter of 22. And then I look at China, it's even more constructive. Do you think we can rebound to 5% here? So as we look away from maybe the index, the S&P 500, Anastasia, can you walk me through where you're comfortable taking pockets of risk in this equity market, both on an industry basis and also a regional basis as well, geographically, through the year 22 and into the back half?
Yeah, sure, John. I mean, first of all, we should acknowledge that we're not out of the woods here. And, we're at 3,800 on the S&P 500. And I think there is a chance that we still break below that as we go through the second half. And certain things could break and they could, consumption is going to slow down. So I do assign a probability that we still maybe get to 3,500. Maybe it's, a pretty bad recessionary scenario of 3,300. But having said that, think about where we came from. We're at 4,700 on the S&P 500, and that was not a buying point. But we are now much, much below that. We've almost matched the average recessionary correction or median recessionary correction of 24%. So I would say for long-term investors, we're not trying to time the exact bottom. The risk reward has improved materially if you're looking a year or 2 years out. So with that said, I like some of the cyclical trades right now. For example, financials have been thrown out like a baby with the bathwater. But I actually think if we do engineer a soft landing, that's a place you may want to look at. Energy. I wanted to take profits on energy just a few months ago because I think it's ran a lot in a short period of time. It has pulled back a lot. And if China does in fact rebound, then I do think that this could be very positive for energy prices. And then last is software. Talk about margins. Not interested in retail margins whatsoever, but software margins are quite strong.
A couple of seconds into the opening bell, we're down 1% on the S&P 500. On the Nasdaq, we're down by 1.1. John, I wanted to give you the last word here. Give me your year-end forecast. I know it's constructive, and walk me through why you think it's achievable, given all the risks on the table right now.
Yeah, I mean, listen, I think that we're going to have a double-digit return between now and the end of the year. And I'll tell you what I think drives it. If you look at what we've seen so far this year, profits are up 7.5% year to date, and they'll probably be up another 5 to 6% between now and the end of the year. So we don't have a profit problem as much as people say. What we have is the valuations. The PE multiple is down over 30%, I think 31% on the market. And that's an enormous adjustment, which makes stocks much, much cheaper. So we think that the earnings continue to move forward. And we think that you get a bounce in valuation, probably a couple of multiple points between now and the end of the year. Stocks will still end the year cheaper than they started, and they'll be up double digits between now and December.
John, can I ask you this? Do you think the Fed will be happy to see that?
Yeah, I talk to people at the Fed. I don't think that they are focused on what the stock market is doing. What do they care about? They care about inflation and jobs. I think, so I really think that they're focused on the mission. And I think Powell may be behind the curve, but he's doing a pretty good job of being clear what his focus is right now. Inflation is too high. They have to address that. And that's where they're going to spend
John,
time.
The reason I asked that, and forgive me for jumping in, isn't the mechanism to achieve that tighter financial conditions? And one element of tighter financial conditions are wider spreads and a softer equity market.
Yeah, but I mean, when you think about financial conditions, and I know that there's some people who define it, including equities, and some who don't. I'm in the camp that you have to look at very simply. If you wanted to borrow money, is it available to you? Let's take a look at the things that I care. Again, I'm talking about what I pull off my Bloomberg terminal, but the Bloomberg, index for bankruptcies is at record lows. That's not what happens when you're going into recession. That's not what happens when the economy is melting down, that fewer and fewer people are going bankrupt. You would need to see that spike if you're going into recession. If you look at people who are defaulting or businesses defaulting on loans or not making loan payments, we're not seeing that at all. Anastasia was talking about a soft landing, but in many ways, this environment there's this. If you look at the stock market, you feel like it's a recession, and then you look at these metrics on the health of the credit market, and it just doesn't feel recessionary. So I don't think the Fed is going to obsess on the stock market and blink on that. They will blink if the consumer falls apart, that's a whole different issue. They care about the consumer. They care about jobs. They care about spending.
John, good to catch up, mate. Looking ahead to a more constructive view from Jonathan Golub of the team at Credit Suisse for the second half of this year, to Anastasia Amoroso of iCapital on her mid-year outlook. Thank you very much to the both of you. Getting things open underway to close out the first half. Brutal start to 2022. Gets uglier going into the end of it. We're down by 1.3% as we close out Q2 on the S&P 500. We're down 47 points with some movers. Here's Abby.
John, well, that recession debate really front and center with today's weak start. 4 down days in a row for the S&P 500 this week, down about 3.5%. And as you were mentioning, one of the worst starts for the S&P 500 in several decades. Taking a look at what is moving beneath that brutal surface, we have Apple down, the heavyweight to all of the indexes, down 1.3%. Even with yields in, the tech investors not going for the stock as valuation concerns become less of a concern. Investors are worried. Bank of America down 2.4% with that rally in bonds and yields in. RH, you were just talking about the surprise that investors seem to have around some of these retailers cutting guidance. Well, RH cutting guidance for a second time this year on slowing demand, down 7.5%. And Carnival Corp down 3.6% after sliding 14% yesterday, as Morgan Stanley says that the company could be facing a wipeout. This again against the backdrop of a potential recession and a wipeout in consumer demand, John.
Abby, thank you. It has been brutal for tech stocks, closing in on their worst performance for a first half in 20 years. JP Morgan cutting its earnings forecast on some of the biggest names, running the following. Our biggest estimate reductions come in online advertising and e-commerce. Given macro pressures, we are increasingly cautious around the impact of a broader economic slowdown, as ad spending is highly correlated with GDP. On the West Coast, let's get to Ed. Morning, Ed.
Yeah, good morning, John. We're down 1.4% on the Nasdaq 100. Almost every single name in the red. It's interesting that JP Morgan call kind of undermines the idea that because we've seen such declines, we're in cheap territory. The valuations have come down to a cheap level. Not really the case. We're on track for our worst first half of the year on the Nasdaq 100 since 2002. I wasn't around doing this in 2002, but that's quite a stat to reel off. Look at this chart in the Bloomberg terminal, though, because there is a split on Wall Street. You look at some of the biggest names, mega caps in particular, and there is still bullishness, at least if you look at price targets. And what I think is so interesting is I hear a lot of names, and I believe your last guest mentioned this as well, talking about free cash flow yields and other metrics that are indicators of value, right? We do talk about value buyers potentially coming back in, but we're also questioning if we've seen the bottom yet. The other interesting call, especially with regards to what Powell said yesterday and this idea of whether or not the economy can withstand tighter policies, to look at Amazon. You know, I think Amazon was one of the names that they cut, but they could benefit in this recessionary environment because they offer lower prices, quick delivery. But if the consumer is soft, is that really the case with a name like Amazon? There's a lot of moving parts here. Earnings season, I'm very excited, Jonathan.
I'm sure you are. I'm looking forward to it. It kicks off July 14th with JP Morgan, unofficially. Anyway, Ed Ludlow, thank you. The retailers have been a pretty poor story. The interesting thing for me about the retailers is that they come out and give you a negative guide, and then a month later, seemingly, they give you another negative guide. Restoration Hardware has been doing just that. They came out, they give you a softer guide, and then they had to come out again yesterday and do it all over again. They said this: the deteriorating macroeconomic environment has resulted in lower than expected demand since our prior forecast, which wasn't that long ago. Our expectation is that demand will continue to slow throughout the year. Kelly Lights has more. Hi, Kaylee.
Hey, John, well, you hit the nail on the head. It is how quickly things are deteriorating for these retailers that is really remarkable here, because we know Restoration Hardware is not alone. We've seen similar moves from Target, for example, all met with really punishing market action the day after. If you think it's bad for technology this year, try being a retailer, because that is the group of stocks that is actually underperforming even tech, on pace for the worst year going back all the way to 2008, globally down about 30%. The story here really being that inflation is putting pressure on the consumer. We saw that reflected in the spending data we got out earlier this morning, and that in turn puts pressure on retailers' ability to pass on the higher input costs they are facing and creates margin pressure. And this is really true across the board. No matter what segment of retail you look at, be it the department stores or e-commerce, specialty retailer, even food retailers, which fall more into the staple than discretionary category, all of them are down double digits on the year. And yet it seems, as is the story really broadly with the analyst community these days, they are a lot more optimistic than investors are, because when you look at the gap between 12-month price targets and the actual stock price for the consumer discretionary sector, it's the second widest of any major sector, 28.6%. So clearly the sell side sees some upside as we move into the second half, John.
Kelly Lice, thank you. I want to keep it on the consumer. David Kostin at Goldman Sachs putting out some brilliant research going into the last weekend, saying the following: declining consumer spending represents a threat to earnings for consumer discretionary stocks and the autos industry group in particular, especially in the case of a recession. David Kostin joins us right now. David, let's start there. The consumer. I want your thoughts on what you're seeing and where you think this is heading.
Well, the consumer balance sheets are in excellent shape. The concern would be on the discretionary spending, given the higher cost of food and energy costs and things like that. So the consumer discretionary stocks heading into the second half of the year, one of the biggest concerns will be the margin pressures that they've experienced. And I see that you saw that in some of the Target as an example. You mentioned earlier about the inventory problems, some of the guide down, but they also raised their dividends by 20%. So I think the belief on the part of many management teams is that this is a more temporary pressure, and the fundamentals of the business remain, modest. And our preference would be more companies that are more resilient in that, and that's going to probably be in the healthcare sector, consumer staples, where you have less margin vulnerability. That's been the long-term pattern in a downturn or recession, that their resilience in their margins is much more powerful than consumer discretionary, where they typically go down pretty significantly, and that leads to lower earnings. And lower earnings, Jonathan, as you know, typically presage lower share prices.
David, if we ask Jan Hatzius about that consumer balance sheet, the strength of the consumer, I think he'd say the same thing. I'm interested in whether there is a different story away from the headline, away from the aggregate numbers that we talk about consistently on shows like this when we talk about the strength of the consumer. David, do you see a different breakdown when you look at low-income households to high-income households? And does that shape your view on where you want to be in pockets of this stock market?
Oh, yes, we did. I mean, the consumer spending is definitely challenged as we look out into the calendar year and into 2023 in particular. So the lower quintile of the income distribution here in the U.S. is going to see, probably a roughly 9% decline in their discretionary spending ability. And even at the highest end of the quintile, in terms of that broader distribution, is probably flat. And so there's still a lot of challenges and so the headwinds of higher costs around energy and mortgage rates, sort of discretionary spending will be pressured, food costs, a lot of pressures. And that's why focusing more on more business-oriented sort of companies where their end market demand is coming would be a preferable area in terms of positioning a portfolio right now.
I want to talk about the price of the story too, David. These issues, inventories at retailers, the change in spend from goods to services. We've been talking about this for a while. We know it's happening, and yet the companies come out and say it, and we get this massive gap lower in the stock. Why do you think that is, David? Why is a story that's talked about so much so poorly priced still?
Well, it's a good question. Look, that's where the sort of the investable gap is, that the idea of earnings degradation has been pretty slow in terms of the negative revisions. The normal pattern, Jonathan, is you get about a 10% or so cut in estimates in the sort of months ahead of a recession, and then you go into recession and the earnings get cut by another 15%. And so the stock market tends to trade ahead of that. So that's the degradation or the degradation of the profit forecast. Stock market moves a lot faster. So that would be the explanation. That basically the market's going to act first and worry about the adjustment in profit forecasts later, which is why the idea of, where are the companies? What companies have more resiliency? Where have you seen a stable growth? You see Comcast, you see Google or Alphabet, you can see Colgate-Palmolive, you can see of somebody like Amgen, you can think of companies like Johnson & Johnson, which they have demonstrated ability over many years to have stable growth. Not necessarily the fastest growth. In some cases they are and they aren't, depending on the year. But those are the attributes that investors should be looking for in this environment that we're looking at right now. We're about to start the second quarter earnings season, kick off in about 2 weeks. And the expectations right now is about positive 5% year-over-year growth. That includes the energy sector, of course. And if you take out the energy, you're looking at down 3%. This will be the first time we've seen year-over-year declines in earnings. That's if the for the expectations are realized, still that's a negative year-over-year growth. That tends to be a concern. It's one of the reasons why the vulnerability is going to remain in the market for the third and the fourth quarter, where expectations right now are for double-digit growth year over year, and that's probably likely to come down a lot as a result of both the results for the second quarter and then more importantly the guidance looking forward. Jonathan,
the stocks are down hard again. We're down 1.6% on the S&P. On the Nasdaq, we're down by 2%. David, before we talk about something out in the next segment, I want to talk about year-end price target in just a moment. Can we finish on this on households? They're getting hammered. Now, David, you did some work going into the weekend about just the household holdings of equities and what you think will happen with them. And it sort of goes against the grain a little bit, David. Can you walk me through on what you and the team are looking at?
Well, right now you've seen actually positive inflows into equities in the first quarter, about $75 billion. We've seen that as well. Got a year to date, probably closer to $100 billion. So there's a lack of alternatives. I know in the last several years, the TINA acronym, there is no alternative, has meant equities particularly attractive. So obviously prices have come down a lot. And the question is, what are the other alternatives now? There are some. Cash is, by the end of the year, maybe yielding 3%. But bond yields have been negative, been a bear market effectively in bonds and in equities. So still there are some parts of the equity market that are more resilient, and that's an area that we're likely to see more inflows. The biggest source of demand is really corporate buybacks. Now, we're in a period of time now where in the blackout period where companies are precluded from repurchasing on a discretionary basis. So stock prices are down a lot. Look at the Goldman Sachs buyback desk, and there's actually extraordinary amounts of repurchases, accelerated stock repurchases that were completed just before, in some cases, the blackout period. And when the earnings season is finished and companies report the results, they're probably likely to move back and repurchase stock. Obviously, buying it down at these levels is obviously much more accretive than it was 20-30% higher.
David, stay right there. We need to talk about year-end price target in this Federal Reserve. We'll do that in just a moment. David Kostin there at Goldman Sachs with us for at least 5 more minutes. We're down 1.6 on the S&P. On the Nasdaq, we're down 2%. Coming up, central bankers reaffirming their pledge to tame inflation.
Is there a risk that we would go too far? Certainly there's a risk. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
That's next. This is Bloomberg.
We're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
Could he be any clearer? Chairman Powell of the Federal Reserve. Equities down 1.6% on the S&P. On the Nasdaq 100, we're down on the Nasdaq. We're down by about 2%. On a session lower on the quarter. Ugly on the quarter on the S&P 500, down 17%. Lucky to conclude this morning with David Kostin and Goldman Sachs. David, I want to come straight to you on your 3-month price target, which was out about a month ago, so I imagine it's a 2-month price target now, and your longer-term price target. And this idea as to whether the Fed put is now a Fed call, and ultimately they do not want to see an easing of financial conditions and a rally in this equity market. Your thoughts on that, sir?
Absolutely. The view here at Goldman is one of the transmission mechanisms to slow the economy is through tightening financial conditions. And so the first order would be the Fed raising the funds rate, which of course it is doing. But the other components of the financial conditions index would be bond yields, credit spreads, the dollar, equity valuations. Those are other building blocks of a tightening financial conditions environment or loosening to the other extreme. And to the extent that equity prices or valuations were to rise, that would be orthogonal or at cross purposes with a goal of tightening financial conditions. Therefore, I would put down as sort of 4,000 would be a level, sort of a ceiling over the next several months. It would be difficult for equity prices to kind of pierce that level on the upside. And that would be the idea if that was to be happening. The Fed might have to be leaning harder into forward guidance and things like that. So our general view here is that the idea of limited or sideways move in the equity market. It's been mostly moving, Jonathan, in the 3,700 to 3,900 range for at least the last month or so. 20% of the trading days this year, the market's moved more than 10%. More than 2% in a day, which is, extremely. It's 2.5 times more levels of volatility than you've seen daily moves over the last, 20 years in terms of the frequency and the magnitude of these big moves. So the idea of looking out towards the end of the year, the sort of baseline scenario would be if the Fed has and the inflation starts to recede in the fall, that would allow equity prices perhaps to move higher. Alternative scenario would be recession. And in a recessionary environment, in a scenario, you're probably looking at a level of the market around 3,150. And the sort of transmission mechanism for how that happens would be a series of significant negative earnings revisions across the market, kind of looking into 2023. And that would take a consensus number right now around $250 for next year in profits. That would probably take that down closer to 200. And then that transmission mechanism, as it sort of degrades, we talked about in the previous section, that would probably lead to a multiple that goes a little bit lower. The idea of the equity market having derated from 21 times earnings to around 16 times or so now, 16 times forward earnings, that's been the total driver, the significant driver, higher rates, lower equity prices. We just haven't seen it on the earnings front. So that's the idea that we would lay out as a strategy and the sort of thought process. And we want to inoculate or eliminate some of the downside risk. And that's why that earnings stability is such an important variable, an attribute of companies in this environment. If the economy was growing more rapidly and rates were lower, you might look to lean in towards more growth. That's not the environment we're looking at right now, and that's why the value of those stable companies is to be prized from a fund manager point of view.
David, this is really important stuff, and I'm still not sure everybody gets it. David Kostin, thank you, sir, of Goldman Sachs. Just on this idea that we've gone from a Fed put to a Fed call. Chairman Powell validated what we've seen in this market. Mike Schumacher of Wells Fargo said earlier this morning, what we've seen is a feature, not a bug, and we're going to see more of it. Chairman Powell said this yesterday. Markets have been pretty well aligned to where we're going. Where we're going next is your trading diary. That's next. This is Bloomberg. Big cracks in credit over the last couple of days. High yield spreads breaking out through 550. That's on a table getting very, very close to that level. We're down 1.9% on the S&P. On the Nasdaq, we're down 2.4%. An ugly end to an ugly half. We're down more than 21% so far year to date on the S&P 500. That's the price action. Here's your trading diary. President Biden heading back to the United States later today. Tomorrow, the big data point, the ISM manufacturing numbers and monthly auto sales in the United States, plus PMIs out of the Eurozone. And I believe we get headline CPI too. Remember, a long weekend stateside, so Monday, no trading. Markets close for Independence Day. The FOMC minutes coming up on Wednesday. And finally, of course, looking ahead to next Friday, the payrolls report to round out the week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.